Record. All right, so one of the things that we're going to be covering today is these SEC regulations for apartment syndications. We had several hundred people register for this webinar, but before we get started, I want to talk to you a little bit about two things. So first off, we have one of the things we launched at the last summit, the Multifamily Investor Nation Summit, was this premium membership for the Multifamily Investor Nation. And it actually includes several different things. There's an online video content. It's not very expensive. And right now, as we are building out some of the content, I'm actually going to be offering a free trial on it. So if you go there, you'll be able to see that free trial. And you can actually take the time to kind of review it and things like that. After that free trial, right now, it's $99 a month. So go there and check it out. I'll type into the chat box right now what the link is. So for those of you who are joining us live, you can do it. For those of you who are not joining us live, you can actually go to mfinpremium.com and find this page. You'll just type your email in there. You'll get access to what that information, what's actually included. And then if you're interested, you can sign up and join us. So we launched this a couple of weeks ago, and I think right now we have just under 50 people that are a part of that program with us. And so I'd love for you to join us there and join us on our weekly coaching calls that we have, and as well as the content and the training that I do exclusively to this group. So we're still doing these weekly webinars. So if you want to just continue to join us there, you can certainly do that. But inside of that membership, that premium membership, we'll have some special guests that'll be joining us as well, so that we can provide some additional value. The last thing I wanted to mention before we get started is our group, passiveinvesting.com. So our group is acquiring large assets, minimum 20 million up to 70 to 75 million, most likely, not most likely, but primarily in the Carolinas. And so right now our portfolio is right at 220 million, a little over 400 investors. And then it's actually a little over 2,000 doors now instead of 1993. It's like 2016, somewhere around in there. And so if you would like to join us on some of these passive apartment investments, then feel free to go to our website, go to passiveinvesting.com. On the top right-hand corner, you'll see this little button here that says join the passive investing club. There'll be a little form that'll show up here. You can fill that form out. My assistant will reach out to you and get you scheduled on my calendar. And you and I will have a one-on-one phone call discussing your investment goals to see if our group is the right fit for you. So let's dive into the webinar today, which is all about the SEC regulations for apartment syndications. We're going to be talking about the ideal number of investors that you need before you are, quote unquote, required to register with the SEC. How do you know whether or not you're selling a security or not? And then what is Regulation D? What are the differences between 506B and C? And which ones do most people actually use and which ones are the lesser common of the two? And then also whether or not you are allowed to advertise your deal and where you can advertise those deals, depending on which type of registration you have. And of course, we'll probably be covering a lot more than that, but that's just kind of what we've laid out here to get started. And to help us out, I actually decided to invite one of our platinum sponsors, Dugan Kelley with Kelley Clark Law. And he is with us today. And Dugan, I want to thank you for joining us. I know I texted you, I think probably a couple of days ago, and I said, it would be great for you to join us. So can you join us? So I'm glad to have you here.
Yeah, thanks, Dan. Hello, everybody. Happy to be here.
Well, before we get started, Dugan, give them a little bit of a brief background about yourself and kind of what you focus on so that they kind of have an understanding, and then we'll dive right into the webinar.
Sure. So as Dan said, I'm a lawyer by background, been practicing over 20 years. We have offices in California and Dallas, Texas. We're a full service law firm, but my personal practice is mainly real estate, handling all phases of real estate, whether it's from the acceptance of your LOI to the closing table. And in many instances, we represent syndicators or sponsors of multifamily deal that are where you're syndicating your equity. As a result, we do a lot of securities work in connection with preparation of your private placement memorandums, the registration of your offerings with the SEC and the state securities boards, and then walking people through how you can legally raise money. And so we've been doing that for a long time. I personally have probably structured transactions over $2 billion. And so last year alone, I think we did 700 million. So there's a lot of people, there's a lot of money in the market right now, and there's a lot of deals. So it's a good time. It's actually a great time for people that want to get into the syndication space and that thought I could never own a piece of an apartment building. And the reality is what Dan and other seasoned gold standard operators are doing are providing you a wonderful opportunity to learn about how to do this. So if you thought that you were kind of shackled to smaller commercial projects, that's not true. You actually have the ability to own an apartment building, and you can do it through this vehicle that we call syndication.
Well, and for those of you who are on and you're really excited about the webinar today, I want you to do me a favor. I want you to find the raised hand button on your webinar platform there. Just raise your hand and let me know that you're actually listening, you're live, and you're really excited about the webinar today, because this is a pretty hot topic, and there's a lot of people that I know, even Dugan gets probably questions every day about various avenues around this particular topic. And, you know, I enjoy this topic because, you know, I feel like I have a fairly good understanding of it, and I can help out a lot of different people, which is why I wanted to do the webinar today. But I also wanted you to be there as well, Dugan, to kind of validate what I'm saying. So if you have questions for the validation to point, or if I say something wrong, you know, feel free to, wait a minute, Dan, let's like clean this up just a little bit, you know. But I know you and I have done some consulting back and forth as well, so we know a little bit about that. And then one of the things I want you to do, for those of you who are live, is I want you to find that chat box. I want you to type into that chat box and make sure you change it from all panelists to all panelists and attendees. And I want you to just type in there really briefly, you know, a little bit about yourself. So nothing long, but just like, you know, you're new getting started, or you've syndicated a few deals, or, you know, you're just investigating, or you just want to be passive, or, you know, something along those lines. So I can have an understanding of who's listening and who's watching right now, because it'll really help us kind of, you know, tailor this content to you specifically. So for all of those of you who just raised your hand, just take a moment right now and actually type that in as we get started with the webinar, so that we can have some good information about who's actually on. And also Dugan can kind of go through there and read some of those himself to kind of see who all's on here. So I always like to have that interaction a little bit, because you get to see what people are on here for, what they're learning about, and all of you who are on here can also do that as well. So let's dive in, Dugan. So one of the most popular questions is how many investors you need before you are required to register with the SEC. And, you know, this is kind of a bad question, right? Because there's so many different things that you have to qualify first before you have to determine whether or not you actually are going to be required to register with the SEC. So before we get started with that, let's actually answer the first question, and I'll have you answer this one for the audience, and let us know kind of how does somebody determine whether or not they're selling a security when they're bringing on investors? What really is a security from the, I guess, the SEC standpoint?
Right. So I'm going to take you back all the way to 1946. Okay. And I'm going to give you a definition. This is a definition that the SEC uses in connection with how they define what a security is. A security, according to the SEC, we get this from the Howey case, which was a famous case if you're interested in it. It's defined as it is an investment of money in a common enterprise with a reasonable expectation of profits to be derived from the entrepreneurial or managerial efforts of others. So think about it in the context of if you're thinking of being a sponsor, or you actually are a sponsor. And I think of it as here's your rule of thumb. It's likely a security if your purpose, the seller of the security or the sponsor syndicator who's looking for equity into the deal, is raising capital, and the buyer's purpose or the potential investor's purpose is receiving a profit on that investment. It's security, which means that you have to follow certain procedures and you're actually selling a security. So Dan is absolutely correct. If it's a very small deal in which you're going to form an entity that will own the apartment building, you may not need to syndicate it. You may only have a couple, 2, 3 partners or co-owners who make a capital contribution towards what that equity is. And as long as they are active managers of the entity that owns the apartment building, you don't need to syndicate it. And it's, we're not selling a security. We're all just going to own an apartment building. We're going to basically do a joint venture partnership. But if you're going to take money from potential investors and they're expecting a return on that investment, it's a security. And as such, there's no limit. There's no super secret friends and family exemptions. So you don't have to follow these rules, or I only had 2 people, or I have 200 people. Last year, the smallest syndication we did was 59,000. So the asset cost 59,000, and there were 2 investors involved. And the largest one was, over $100 million with hundreds of investors involved. So between very small and very large, the question is, what are your investors expecting? That will tell you whether it's a security or not.
So when an investor is kind of sitting there trying to figure out what they're going to be doing, whether it be, syndication versus JV, obviously if it's, 2 or 3 people, there is a potential to be able to give them some form of responsibility inside of that, that JV deal, if you will. But is there a certain number that maybe you would say that, if it goes over a certain number, it's going to be kind of hard to justify that all of those people are actually doing something in that property?
Yeah. So, we always want to be truthful, honest, transparent, right? So the reality is, if you have your 50 closest BFFs and they're giving you some money and they're expecting a return on that investment, but they all want to be active participants to avoid essentially the professional fees associated with the preparation of the private placement memorandum and going through compliance with the SEC, that probably is not going to pass the smell test. I was asked last year at one of the conferences in which I was speaking whether they had 5 people, and one person was really not going to do anything, but they were just expecting a return. I said, well, you're selling a security, as opposed to if you had 5 friends and they all said, let's do 20% or however you're going to divide it up, and here are the various roles associated with it. That's fine. That's a legitimate enterprise. But the question is, I always tell clients back, I push it back on them and I say, well, honestly, if you were told this, does it pass the smell test? Are you really an active member of this entity, or is this just a way for you to avoid having to pay the fees associated with having to go through syndication?
So since you brought up fees, let's talk about that for a minute, because obviously when we're talking about syndications, there can be some, pretty expensive charges or fees associated with it. So kind of giving us a little bit of a range here, for somebody who's doing just a 2-person syndication, is it going to be the same cost? So for that same, 2-person $59,000 purchase to syndicate it versus somebody who's doing, a larger, 10, 20 or $30 million syndication where they're raising a lot more equity?
Right. So this just totally depends upon the lawyer or law firm that you have that handles your securities work. I tell people and clients all the time, if you have an existing securities lawyer or real estate lawyer that you like, trust, and know, stay with them, because that relationship is important. It's like a marriage to a certain extent, because if this is your business and your intention is to do this over and over and over again, you will have a high level of interaction with your lawyers. Many lawyers that do this type of work charge flat fees. That means they're not by the hour. If they're billing you by the hour, the likelihood is that they don't do a lot of this work. So whether you're hiring a real estate lawyer to handle the purchase and sale agreement and all the loan documents and the conveyance and transfer documents and deal with title and survey and get you to the closing table, or you're hiring a securities lawyer who's going to handle your PPM and advise you on your structure and form the entity that will ultimately be sold in part to investors, those lawyers charge a flat fee. So we typically are somewhere in the neighborhood of $8,500 to $10,000 flat fee for securities work, regardless of the size of the raise or the style. These are for Reg D offerings, 506B or 506C, what we're talking about here. Other charge other fees. It just depends. I won't speak obviously to them because I don't know what they charge, but you can expect somewhere in that all the way up to, depending on the style of the offering, it could be as large as $50,000 by other firms, which they may charge. It could even be more. It just depends upon what they charge and how they work with you in connection with your offering.
You were talking about, you're speaking around. Are you going to be at the Best Ever conference?
I will. Yeah.
I thought you were going to be there, so I thought I'd mention it to everybody. We actually have a special promo code for those of you who are interested in joining us. I'm going to be speaking at this event in 3 different sessions, but you can go to bestever2020.com to be able to register for this. This is coming up later in February, and they actually have a promo code for us that we can give to you. It's actually just, so if you go to the website, just bestever2020.com, and go there, you can use the promo code MFIN, and you'll get 30% off your tickets. So that's the highest price I've seen on those tickets for the general public. So, but for those of you who are watching, you want to join us there. This is one of the best, if not the best, multifamily. It's not only multifamily, but real estate related event that has a lot of multifamily people that attend this and are really high level players. So I would definitely suggest that you check that out. That's just bestever2020.com. One of the things that I wanted to show on the screen as we go over Regulation D is, so I'm going to talk about Regulation D, which you kind of already mentioned to it a little bit, as also this, really answering these last 3 questions here is I actually put a table together last year, Dugan, that because we had a lot of people asking, how do I know exactly what's the difference in these various things? And so I'm going to share this with you. And again, if you find any errors on it, feel free to correct it for me, Dugan. This is definitely not something he put together, it's something I put together. So if there's any errors, it's totally my fault. This was actually, I did a webinar on Regulation D versus Regulation A, and then the 506B and C versus the Regulation A's. I do the Tier 1 and Tier 2. So for this webinar today, we're not going to focus on Regulation A, but you can see kind of how it would still stack up along the same lines as the 506B and C. So as we go through this, let's first kind of define what is Regulation D, why is it there, Dugan, and then we can kind of walk through some of these variances between the 506B and C. And if you see any discrepancies or anything like that, you can certainly let me know there as well. So let's talk about Regulation D.
Okay, so Regulation D. So this is what the vast majority of you that are interested in sponsoring and syndicating multifamily units around the country. These are the exemptions that you're going to be relying on. So when we talk about exemptions, remember what we're really talking about is being exempt from having to publicly register. So we're not talking about corporations like IBM, Apple, things that are publicly traded companies that do offerings. What we're talking about are private offerings. And what the exemptions are associated with our offering being exempted from essentially that public registration. The 2 primary exemptions that most people rely on are 506B and 506C. Dan's chart is very helpful in that there are some key differences between 506B and 506C. The biggest one is this idea of advertising. So on a 506C offering, you have the ability to broadly advertise. So historically, the SEC has, before the passage of the Jobs Act in 2018 and the 506C essentially coming onto the scene, there was this general prohibition in general that you could not advertise or generally solicit people you didn't have a existing relationship with to come and actually invest in your private offering. And with the passage of the Jobs Act in 2013, we have this 506C exemption that allows you to broadly solicit. It means you can do it on radio, and I hear this all the time. Dan, you made it as well. Hear radio pitches for people, and they say, and at the very end, when the guy that's like an auctioneer is blizzarding the disclaimer, and he said, this is for accredited investors only, this is a 506C opportunity. And what they're really saying to the public when you hear that is this is a 506C offering. It's not a 506B offering, which limits us to no solicitation, which is still the traditional historical prohibition from the SEC. And I think it's important to understand why does the SEC not want you to broadly solicit? people that you don't know to participate on a 506B offering. Well, think about it. If you don't know these people, there is a stronger likelihood that you don't have a good baseline of understanding of what their financial capacity is, whether this type of investment might be suitable for them or their family. And so what the SEC says is we're going to lean towards investor protectionism, meaning we're going to protect potential investors more by keeping in place this restriction. And you don't need to advertise on a 506B opportunity because everyone that is investing in your deal on a 506B already know. You don't need to go out and advertise. But on a 506C offering, we're going to allow you to advertise, but we're not going to allow you to take in investors that do not meet the accredited investor definition, which means the general two ways in which you will see the accredited investor definition for you today is that their net worth is something in excess of $1 million, backing out the value of their primary residence, and that they've made $200,000 2 years prior to the offering with the reasonable expectation of making $200,000 the year that they receive the offering, or $300,000 combined with their spouse. Those are the two primary ways in which you find accredited investors for 506C offerings or determining whether somebody is an accredited investor under 506B. But if you can advertise, the SEC says, hey, if you're an accredited investor, the likelihood is that you're probably better able to protect yourself. So we're going to allow sponsors to advertise to potential investors, even though there's no pre-existing relationship, even though they're complete strangers. Why? Because if they're not an accredited investor, they cannot invest in your 506C offering. That's a key difference between the two. That's important for you to see that. And Dan has highlighted that on his helpful chart for the rest of you.
Yeah, and I think, one of the things that you have to realize with the SEC is the SEC was created for a certain type of investor or individual. And it was actually created not for the accredited investor. It was actually created for the non-accredited investor to protect the non-accredited investor. Because if you look at all of the regulations, especially in this Regulation D, and Regulation A, these different ones you see on the screen here, the 506B, C, and the Tier 1, Tier 2, they really have no care about the accredited investor. Like, they don't really care about the accredited investor. Once you reach that status, you can pretty much do whatever you want. But once you when you are still a non-accredited investor, that's also when that's when the SEC says, well, we want to try to hold your hand and help you a little bit to make sure that, because you are probably less sophisticated, that you know what you're actually investing in. And they are also, considering doing some changes. And I don't know if you want to touch on that just a little bit, Dugan, if you have any updates on some of the changes that they're seeing right now, they're working on right now, as far as adjusting that accredited status as well.
Right. So the SEC is actually looking at a potential change in how they define accredited investors. Currently, it's open for public comment. So the SEC is actually looking at loosening up the definition of accredited investors. So I get asked a lot as to what's going on. Why are they doing this? And so, well, we don't we don't know exactly the inner workings of what's going on at the SEC. We do know a few things, right, from us that are in the business, that see a lot of these things. And we know that private equity is important. Private equity and encouraging private equity to fuel small business growth in the United States is very important. Small business growth and the fuel that comes from private equity is a big churner on the U.S. economy. So it doesn't matter what political party you belong to. It doesn't really matter who sits in the White House. Everyone in the country is in agreement that private equity is a big factor in job creation and in the fuel for our economy. So you see from the SEC that if we have definitions of accredited investor that no longer really fit for either the demographics across the country or for people to be able to invest in opportunities to help grow their money, then we need to do something to helpfully loosen those definitions up. And so that's where you're going to see maybe a little lean away from investor protectionism, more towards encouragement of being able to provide opportunities that otherwise are foreclosed to people because they don't meet the pure definition of what an accredited investor is. So like, for instance, one of the potential changes are somebody might not have a high net worth, but they might have advanced degrees. They might have some sort of financial degree or backing or educational component that would help them meet a new definition of an accredited investor, but they might not have, their net worth might not be more than $1 million. They may only make $175,000 a year or $150,000 a year, or be a college professor, or any number of options out there that theoretically the SEC would say, yeah, you are an accredited investor. You're an incredibly sophisticated person that can protect yourself. And we're not, like Dan said, we're not going to worry that much about you because you know what you're doing. You're able to have sufficient knowledge to properly evaluate the merits and the risks associated with the potential investment.
So I see a couple of questions coming in. So let me just go through this chart real quick. Ignore Regulation A right now because we're not talking about Regulation A at all. So what I'm going to do is I'm just going to raise this up a little bit and kind of zoom in so that you guys can see this entire chart to make it easy for you to kind of stay focused. Because I know some of you were kind of asking some questions about Regulation A. But while I have it on the screen here, what I would suggest that you do is pull out your cell phone and take a picture of this on your screen. Or you can use the print screen button on your keyboard. Not a lot of people know about this little feature, but right above your arrow keys and above your keys that says delete, end, page up and page down, there's a button that usually says PRTSCN. That's your print screen button. So if you actually hit that button, you can open up a Word document and actually Control V as in for paste, and you can actually paste this document inside of a Word document so you can actually save this for future reference. So that'd be an easy way for you to be able to save this. But a couple things I want to mention here, Dugan, and again, if I say anything that's not correct, feel free to stop me. But, the dollar limit raise on these 506Bs and Cs is unlimited. So they don't say you can only raise 5 million or 10 million or whatever the case is. And the 506B and C that we're referring to, you can raise an unlimited amount of money. And you can also raise an unlimited amount of money from a sophisticated investor or an accredited investor. The limitation, though, is the number of investors of those sophisticated investors. So both of these on a 506B and C, you can accept unlimited accredited investors, but the biggest stipulation with the accredited investors is that on the 506C, they have to be verified accredited investors, and you have to do that proper verification. And then on the 506B, they are self-verified or self-certifying that they are an accredited investor. But one other stipulation that kind of goes into it, which is right above here, is this, you still have to have that prior existing relationship with that accredited investor. Just because they're an accredited investor doesn't mean that that particular statute goes out. You still have to follow that rule that is put there where they are accredited, whether they're accredited or sophisticated or non-accredited, they have to have that prior existing relationship with you. And so let's talk about that real quick as well, Dugan. What would really substantiate or qualify someone to have a significant or substantial substantive prior existing relationship with someone?
Yeah, so we used to think that there was some sort of magic time limit, that I needed to know somebody for 30 days, or I needed to have 3 dinners with them and 2 outings to the bowling alley, or we needed to have some sort of high level of social interaction for a long period of time in order for that sophistication level for us to develop that pre-existing substantive relationship. The SEC says no, there's not a magic time limit. It really depends. And that what the SEC says is that the potential investor, has to have enough knowledge and experience in business matters to evaluate the risks and merits of an investment. So What does that mean? Well, the question is, it doesn't give us a lot of guidance on time limits or what the level of interaction is. You can theoretically develop a pre-existing substantive relationship with somebody over a very short period of time, depending on whether, if your knowledge, when I say you, meaning the issuer or the sponsor syndicator, has sufficient knowledge about that potential investor that would give yourself a high level of confidence that they have the ability to properly evaluate the merits and risks associated with the investment. So if you met somebody today and you had an offering today, that would not be a suitable investor for a 506B opportunity. For one, you don't have enough information. You don't have a pre-existing relationship, meaning pre-existing. If your offering is already live, you don't have a pre-existing because you just met the person. So what I encourage clients to do is really find out about your potential investors. Dan is one of the best people to talk because he is one of the best operators that I know in the country as far as clear communication, constant communication, and getting to actually know his potential investors before Dan offers them an opportunity to invest in an offering. He really wants to get to know them and understand exactly what is their level of sophistication, education, experience, what are their goals associated with the potential investment. So if your whole goal is designed on a volume basis of churning new people in and out, that's not a good method of developing a good, honest, transparent relationship with your potential investor. You have to really care and take the time that is necessary and needed in order to understand who your investor is.
So another question coming in here, Dugan. I'm gonna have to limit the questions because I know this is a very big topic and we have just a few more minutes left. I try to keep these to about 30 to 35 minutes, and we're coming up against the clock. But there's two questions coming in. One from Abel, one from Mark. I'm gonna answer. We'll have you answer Mark's first, which is what's really the definition of a sophisticated investor? Because I think this is something that's really has been confused in this space, because sophistication doesn't mean that you're accredited or non-accredited. You should most accredited investors are actually going to be sophisticated, right? So really what you're looking for is the non-accredited sophisticated investor, right? And so obviously we know what a non-accredited investor is, someone who's not accredited, that doesn't meet those accreditation standards that you mentioned earlier. But what would constitute somebody to be an actual sophisticated investor?
Right. So the SEC's definition, they're definite, this just like we read the definition of what they consider to be a security. Here's what they consider to be a sophisticated investor. A sophisticated investor, according to the SEC, has, quote, enough knowledge and experience in business matters to evaluate the risks and merits of an investment, close quote. So that doesn't really, if you're an engineer or you're a very precise individual and you want like a 3-factor analysis of what it really takes, the SEC doesn't give a lot of guidance in regards to that. But again, what that really does is that forces you. So think about it from the SEC's perspective. They're thinking about investor protectionism. So it's not a one shoe fits all for every potential investor. They're pushing back the responsibility on you, rightly so, as the syndicator sponsor, to get to know the potential investor, to actually figure out if they are sophisticated or not. And if you're doing a 506B offering, which the vast majority of you will do, the vast majority of you will not be syndicated and sponsoring 506C opportunities. Why? Because the vast majority of potential investors that I know, that you know, that do not meet the technical definition of accredited investors. And we don't want friends, family, people that we know, love, and trust out of a potential offering. And so the SEC allows us up to 35 of friends, family, loved ones, people that we have a pre-existing relationship that meet the definition of a sophisticated investor, but do not meet the definition of an accredited investor. So we can have up to 35 of those people that are not accredited in a 506B offering versus on a 506C offering we already talked about. You have to have only accredited investors.
So I have a couple of follow-ups to this, just real quick. One is, I've actually gotten this question a lot, Dugan, and I think I know the answer, and I just hope I've been telling people correctly, but I always tell people, I'm not an SEC attorney. Make sure you check with one. So we have one here today. Question is about, do the syndicators themselves or the active partners, do they have to meet those qualifications to be an accredited or non-accredited or sophisticated investor status?
No, so the sponsors have the ability, they have the ability, if they wanted to invest in their own offerings. They don't have to be an accredited investor if they wanted to syndicate a 506E offering. You don't have to be an accredited investor in order to syndicate that.
Obviously, it helps when you're trying to raise money from accredited investors if there's somebody on the sponsorship team that actually meets that same qualification as well.
Of course.
So the last thing here I'll cover, which is about, a big question that people always have about compensation when you're raising money. I know there's several of you that have some good questions in here. And so Dugan, while I'm asking this question, if you want to go ahead and type into the chat box, just make sure it says all panelists and attendees, your email and your phone number, whichever one you want to give out right now. And that way, for those of you who are on, if you want to email him, I believe it's just Dugan at kelleyclark.com or kelleyclarklaw.com. So I'll let him type his email in there. And then once it is, for those of you who are watching the recording, I'll read it out to you. But the question is from Abel, can you explain how to stay in compliance with SEC syndicating, specifically to raising capital when paying out or providing equity for various amounts of effort in the deal? Example, in advance, we know that one GP will raise $1 million, another GP will raise $250. How do we provide larger amounts of equity or acquisition or payout to reflect their larger contribution or efforts in the capital raising section?
Right. So, I mean, we could have a whole, nother podcast on the ambiguities that currently exist in the SEC regs between what the SEC potentially could treat as an unregistered broker dealer versus somebody that is a registered broker versus a legitimate co-sponsor. So here are a few things that you need to keep in mind. One, you cannot have a commission-based style compensation plan that is tied to some sort of mathematical formula. Meaning, if you raise for me, I'm going to give you 10% of anything that you raise. Why does the SEC not want us to have a commission style compensation plan? For a variety of reasons, but think about it from the standpoint of what Dan told you. The SEC is primarily investor protectionism. So if you have a commission style compensation plan, do you think that you're going to be more likely to shade the truth or not be as open or honest with a potential investor who wants to know what all the risks are associated with the investment? Because you're incentivized financially to theoretically be paid by the consummation of that potential investment. So what I tell clients is there's no prohibition or restriction on you having multiple co-sponsors on a deal. And in fact, many, if not all of you that either currently syndicate or are looking to syndicate will actually need to have multiple people that will co-sponsor that deal. What do I mean by co-sponsor? Well, that means like Dan and several of Dan's friends potentially would come together and say, hey, we want to buy this large apartment building. Let's all come together and we will co-sponsor this deal. But it has to, again, pass the smell test. And that is the sole reason that Dan invites somebody to co-sponsor can't be just to raise capital. They have to fulfill other roles and responsibilities in that. And so we've created a co-sponsorship agreement that outlines the expectations of sponsors associated with that and a checklist to remember to help kind of guide you along in order to make sure that you actually are doing what you said you would do. And it is very common for the lead sponsor to tell all of the co-sponsors or junior co-sponsors that are legitimate sponsors, I'm going to divide up the compensation that the sponsor is going to receive on this deal according to the level of effort that people do, or the level or the roles that people do. So whether it's at-risk capital, earnest money, due diligence, asset management, investor relations, finding a bank, or the debt side of it, or raising capital, all of which are included in roles that the lead sponsor is going to have to do. Why? Because if the lead sponsor isn't doing those roles, then the deal is not going to get closed. So if the lead sponsor is fulfilling all of the but needs assistance, and somebody that says, hey, I want to participate and be a legitimate co-sponsor, can also fill those same roles, maybe not to the same level of the lead sponsor, but they do honestly fulfill roles other than just raising capital. They should have an expectation that they would be treated fairly and compensated. They would receive some form of the compensation in connection with the deal. So again, straight up, I'm going to raise money and you're going to give me a cut of it. That's not appropriate. That's not compliant. I tell my clients, but if somebody says, hey, I've got a potential deal, it's a large deal, I can't take this down myself, I want you to come along and participate as a co-sponsor. Or you approach somebody like Dan and you say, Dan, would you consider me as a potential co-sponsor on one of your deals? That's a possibility as well. Seasoned operators are looking to help people learn the business and do it. And there's a kind of an abundance mentality in our community that says we want to help people learn how to become financially free.
Well, Dugan, I know it's a very hot topic, and I'm sure there's probably lots of questions that people have around this. And we have your email on the screen right now. You can see in this little enter your details below to register. I went ahead and copied and pasted it in there. So for people who are on the recording, if they have further questions for you, you can email in there, dugan@kelleyclark.com. And then for those of you who are on the webinar platform, he also put in his email there as well. So just want to a couple of last things. So for those of you who were on here earlier, you'll remember that I talked about the MFI and premium membership. Would love each one of you to join us there. There is a free trial right now. I've typed it into your chat box. After the free trial, it's only $99 a month. I'm offering that free trial right now because we are in the process of adding a lot of this content as we are developing the program. We are doing weekly coaching calls right now and things like that. So go there, check it out, see what else is included so that you can kind of join us for some of our future opportunities. And for those of you who are interested in investing passively, go to passiveinvesting.com. Love to have that conversation with you. Dugan, thank you so much, even on such short notice, for joining us here. And I hope a lot of people reach out to you and be able to help you out with your practice there as well.
Thanks, Dave.
All right.
Thanks, everybody.
So much, Dugan. Talk to you soon.